Hi, I'm Marc Rinfret, Senior Investment Advisor and Senior Portfolio Manager with the LePoidevin Group. I'm excited to welcome all of you to the first edition of our new educational video series. We might need to work on that name a bit, but we'll get there. The goal is going to be to try and roll out a range of topics from investments, economics, financial planning, estate planning, taxation. Sometimes it'll be more basic, other times more complicated, but the goal is having all of our clients come away with a better understanding of their portfolio and what's happening in it. Ultimately, this is for your benefit and to add value to your experience in working with our team. So let us know how we're doing. And as always, thank you very much for your ongoing commitment and support. So we put our heads together and thought about what would be a good topic to start this whole educational video series with, and we landed on exchange-traded funds, more commonly known as ETFs. So before we talk about ETFs, what they are and how we use them and how they're applicable, some of the pros and cons, we thought it made sense to go back and look at the history of ETFs and how they came to be. The early days of ETFs actually experienced a couple of false starts. The first attempt at an ETF was the index participation shares, which tracked the S&P 500, and that was back in 1989. Despite quite a bit of investor interest, a federal court in Chicago actually ruled that the ETF looked more like a futures contract and therefore needed to be listed on a futures exchange, which didn't make it all that accessible to retail investors. The creation of the first modern ETF, something that looks and resembles a lot of the ETFs today, actually has its roots in Canada and was issued by the Toronto Stock Exchange in 1990 and was called the Toronto 35 Index Participation Unit Security. That product allowed investors to participate in the performance of the TSE 35 Composite Index by owning one security and not having to own each of the individual securities or companies that made up that index. 3 years later, in 1993, State Street Global Investors released the S&P 500 Trust ETF, which today constitutes still one of the most actively traded ETFs on the planet. Okay, well, now that we've had a history lesson on where ETFs came from, let's talk about what ETFs are. Exchange-traded funds are actually exactly as the name implies. It's a fund that trades on an exchange, whether it's the New York Stock Exchange or the Toronto Stock Exchange. And the fund aspect lends itself to the fact that an ETF is a single line item that gives you a broad exposure to an underlying group of securities, whether that's an index like the Dow or the S&P 500, a sector like utilities, financials, a country, a currency, commodities, or all sorts of other things, as we'll talk about later. In terms of pricing, ETFs have two aspects. The market price is similar to an individual company like Coke or Apple or any other company that trades on a stock exchange. It has a market price, and then it has a bid and an ask, just like an ETF. The other aspect is called the net asset value. So the net asset value of an ETF represents the value of each share's portion of the fund's underlying assets and cash at the end of the trading day. Institutional investors and broker-dealers actually play a fairly crucial role in helping to keep the ETF's market price, the one we can pay for, buying or selling on the exchange, in line with the net asset value of the ETF's underlying security. And they do this by issuing or redeeming on a daily basis shares called creation units. And that's really intended, again, to make sure that the security market price on a daily basis stays as close and as representative of the net asset value of the ETF. Okay, so let's talk about some of the advantages around ETFs. First and foremost, diversification. You have a single line item security that gives you exposure to a vast underlying basket of securities. Second of all, liquidity. ETFs trade on the stock exchange. Unlike a mutual fund where it's daily pricing or monthly or sometimes longer, an ETF can be bought and sold on a daily basis. Transparency. If you stick to passive, vanilla, straightforward ETFs, pricing is typically going to be very close to the net asset value, and the holdings are going to be fairly straightforward. S&P 500, Dow Jones, again, all fairly straightforward and transparent. Tax efficiency. When you own an ETF, taxation is more within your control. You decide when to buy and crystallize the gain or loss, as opposed to a fund where there's activity happening within the fund and a lot of those taxations are distributed out beyond your control. Lastly, ETFs often provide a way to gain exposure to things that might otherwise be challenging to do on an individual security basis. So clients of ours will know that we have owned the Wisdom Tree Europe ETF, HEDJ, and we've also owned the Vanguard Europe ETF, VGK. The subtle difference is that one of these has a currency hedging aspect and the other does not. So we've flipped between owning these for clients who have been around long enough, and it's allowed us to gain the market exposure we want, but also be able to express that currency view. Anything that has pros associated with it probably also has cons. So let's look at some of the disadvantages associated with ETFs. Firstly, fees. The more ETFs you layer into a portfolio, especially active ETFs, the more embedded fees are going to be in the portfolio. Second of all, passive ETFs lack a rebalancing, which can often lead to concentration. Take the S&P 500, for example, heading into this year. Buyers may have felt they were getting S&P 500 businesses of exposure, when in reality, they were actually getting a lot of technology exposure given how overweight that sector had become within the 500 businesses of the S&P. Like a lot of good things that come in the financial world, we often take them and make them overly complex. And I think that's what's happened with ETFs. Now we can get all sorts of exotic structures that are underlined by derivatives, or we can get 2 and 3 times the exposure to a particular commodity or asset class. All of these structures are complicated, they're more expensive, and frankly, there's a lot more ways to lose money than make money when looking at these different structures. Lastly, ETFs that try to get exposure to less liquid securities are often at an inherent disadvantage. Quite often, these ETFs have rules or provisions in place that don't allow them to own certain types of securities, and so the exposure you're trying to get might not be the one you're achieving. Okay, so let's try and put a bow on things. We've looked at what ETFs are, pros, cons. Let's talk about application. How do we use them in portfolios? First and foremost, we want to try and use them sparingly, okay? We want to avoid complicated structures that are underlined by derivatives, that are underlined by futures contracts that are going to be more costly. Ultimately, if we can find ETFs that serve a specific purpose, we think they work well in the confines of a well-diversified portfolio. Take, for example, some clients who have been around long enough might remember this, but back when the tax-free savings accounts were first opened, the maximum we could put in was $5,000. So we were trying to think of good ideas to put into an account that was limited to $5,000. So we wanted S&P 500 exposure. We wanted to be able to buy it in Canadian dollars, but we also wanted some exposure to the US dollar currency because the Canadian dollar at the time was quite high. So we approached Vanguard and we actually had them create an ETF that would provide clients with S&P 500 exposure, could be bought in Canadian dollars, but would also participate in the US dollar if it ended up appreciating. So that was a really good, I think that's a really good example of how ETFs can be used for very specific purposes within a portfolio. So that's it. Thanks for tuning in. I hope you found it useful. I hope you learned something. We'll definitely be back with more content. And if you have any feedback, let us know. Thanks again for your support and again for tuning in.